I think that it's more hype than anything else at this point.
The most significant money is yet to come. Can you explain that to us?
Yeah, actually, I have to give credit to Jeff Christian. Jeff said it years and years ago, and of course, my ears perked up, and he said 90% of the move comes in the last 10% of the time in the silver market. And that caught my attention. Of course, I knew what he was talking about, so I went home and I did the arithmetic,
Yeah.
and I found out that during the Hunt situation in the late 70s, 1980, that if you were a patient investor and you bought silver in 1965 when it was taken out of circulation at $1.29 an ounce, and you waited until January 1979, you'd hit an all-time high of $6 an ounce. But if you were a rank speculator, you didn't know any better. You got in at $6 an ounce in January 79. You waited 1 year. It went from $6 to $50. So you had over an 800% increase in 1 year. So if you do the arithmetic, what you find out is that move from 6 to 50 is about 90% of the move. And if you look at it from 1965 to 1980, it was in about 7% of the time. So the rough numbers. Now, just because that's what happened in the past doesn't guarantee it'll happen in the future. But what I do know in all markets is that the final leg, the Elliott wave guys will call it the third leg up.
Yeah.
It's usually double the second one. So the second leg up in silver was from about $9 to 50. So that was about a five-fold increase. So if you double five, that's 10. So you go from the bottom this time, which is roughly 12 during the CV19 situation in March 2020. And it was a spike 12. I don't count it, but I'll use it as the low. So 12 times 10 is 120. Now, I've said back in 2003 in my first book that silver would be $100 an ounce, roughly speaking. I do expect triple-digit silver, and I still do.
David Morgan emphasized that all markets experience a parabolic final run-up, where fear of missing out drives prices higher until there are no more buyers, leading to a sharp decline. He explained that, technically, to identify the last leg of a bull market, one should wait for gold to break its all-time high, around $2067. According to Morgan, the price needs to stay above this level for at least 3 days with above average trading volume, what he calls the Morgan rule. If this happens, there's about an 85% chance that the market will continue to rise. He noted that in commodity markets, old resistance levels become new support. Therefore, once gold surpasses $2,000 and remains above it, this level becomes the new support, making it unlikely for prices to drop below $2,000 without significant effort. Morgan also referenced Bill O'Neill's advice to buy at new highs, as stocks often make several new highs as they climb. The key is to follow the trend with a stop-loss order to protect gains. Reflecting on his experience during the silver run-up in April-May 2011, Morgan mentioned that he accurately called the top for his subscribers. In retrospect, he might have avoided the market for a decade, but he remains a strong advocate of sound money principles.
You know what? I'm happy you're bringing this fresh perspective, because that's what I repeatedly hear. Well, I don't want to touch, gold if it's, at these levels. I don't want to touch silver at these levels. So that's a different perspective there, David.
Well, if I could go on, I'll give you another quick example.
Yeah,
This
please.
one was in Forbes magazine years ago, and it was a professional trader, and he wasn't doing too well this particular year, so he took a year off. He studied everything he had done and everything he'd done wrong, and he looked at all the markets, but he's a futures trader. So when silver came along, he was back in the market, and what he did was what's called take the middle. So what he did was he waited for that new high, and the new high for him when he got in was like $15 an ounce. And remember, 6 was an all-time high in 1979 after years. So 15, that's over double. You sounds like you're an idiot. You're buying high. Yeah, he was. He got it at 15. He got out at 35. He left some. He knew the momentum was still strong. He knew there was a lot of buying. He knew he could sell in the strength, which is one thing you better learn in the futures market. So he took out 15 to 35. So what's that, $20 on a leverage with many, many contracts. And he told his wife, we're out. And she'd heard that many times, we're out, out of the position. He goes, no, honey, you don't understand. We're out. We are done. We are retired. We're finished. We got enough money for the rest of our lives. It's over, complete. So that's kind of a cool story, but it proves the point again of what I'm saying is once this thing goes parabolic, pay attention. And it's really tough to call the top. I will be helping my people. David Smith and I wrote a book called Second Chance, how to make and keep big money during the coming gold and silver tsunami, because when this thing runs, everybody and his brother-in-law is going to want to get in, and that's fine. And they're going to be getting in at higher and higher prices, but you've got to look at it. And the hardest part for me, Daniela, is do I tell people to sell precious metals for fiat? Do I really do that? And that's going to be a tough call, because if the system collapses further or whatever's going on at the time, you certainly don't want to be on a pile of paper if it keeps depreciating. So I'll address that at the time.
Right.
I think the best thing to do is just take it, a day at a time and see how it works out. But anyway, probably overemphasized, but very interesting.
That's a good point you're bringing up. That's a good point you're bringing up. Is what do you do one day when you want those profits?
Yeah, my thought right now is you could still contract in this country and other places, and you might buy, let's say, raw land for silver. You could contract. I could contract with somebody that had land and say, I'm going to pay you, 1,200 ounces of silver for your 40 acres, and we agree, and I give them the silver, and they deed the land to me.
Let me ask you this before you mentioned something about if precious metals ever re-enter the monetary system. So a good segue here to talk about the announcement with you that you've seen. The BRICS have now announced on Russian television that they're looking to work or release some sort of gold-backed currency. We have the upcoming BRICS summit coming up next month. Lots of buzz surrounding this news item. I'm going to ask you what I've been asking the other experts. Do you buy it, and how feasible and likely is it?
Yeah, I'm writing about in the paid version of the Morgan Report, but I'll kind of give you my thoughts now. First of all, going back to my mother, talk is cheap. I mean, just because you make an announcement, that doesn't mean much of anything. And that's basically what they're doing. They're going to announce that the BRICS, are going to have a gold-backed currency. And it's possible, and it's probably probable at some point that they will. But it's very difficult to get those 5 different cultures to really work together. It's kind of like the Euro situation. I mean, the Germans have a lot different work ethic and vacation strategy and all that than, let's say, Greece does. And so you put them all together, it's rather difficult to stir the pot and mix it up and make it work. Euro, again, is an example. So here we've got Brazil, we've got India, we've got Russia, we've got China. If they make it convertible, where you can buy the BRICS currency and immediately exchange it for physical gold, then that will impact the market. And if the BRICS decide to peg the gold price higher than, let's say, what the COMEX or the LBMA has, that will cause an arbitrage situation, which people say, oh, gold's at 2,000 and they're pegging it at 2,200. So it'll almost immediately correct, because of the arbitrage like that in any market. Markets are very efficient, especially when it comes to arbitrage. So they could be setting a new price for gold in, US dollar terms or yuan terms or ruble terms or whatever. I think that it's more hype than anything else at this point. I do like the fact that it proves one of my basic premises, and that is, at the end of all great inflations, that the free market comes to the fore and starts finding ways to mitigate the problem. And what have we seen? Well, we've seen a lot of crypto over the last decade, right? That's to mitigate the problem. That's to get out of the current situation. You got barter clubs. Of course, you've got precious metals all the way along. And then you have individual counties that have their own dollars. Ithaca dollars comes to mind. You can look it up on the web. But this is where communities agree that they're just going to bow out of the system. These are small communities usually. But, we're just going to make up our own receipts for labor, and we're going to pass them around our community, and this is how we're going to settle business in our small town. That's, kind of a one-off, because you couldn't do that on a national basis. But coming back, so there's countries that are banding together that's saying, hey, we've had enough of this U.S. dollar dominance. It's really based on nothing than hot air and politicians' rhetoric, and we're tired of giving you real goods and services for it, so we're going to start our own currency. So It's all shaping up to the fact that we're near the end game. The fact that we're
David Morgan's statement provides a thoughtful analysis of the precious metals market, particularly focusing on the dynamics and potential future scenarios for gold and silver. Here are the key takeaways from his remarks. Morgan highlights the importance of recognizing and capitalizing on parabolic market movements. He uses the example of a professional trader who re-entered the market when silver was priced at $15 an ounce, riding the surge to $35. This story underscores the potential for significant gains during the final, rapid ascent of a bull market. Morgan's point is that, despite initial hesitation due to seemingly high prices, substantial profits can still be made if investors pay attention to market signals and trends. Morgan suggests practical alternatives for utilizing precious metals, such as purchasing raw land. This example illustrates the versatility and real-world applications of silver and gold beyond traditional investment vehicles. It also reflects a strategy to preserve wealth through tangible assets, which can be particularly valuable in times of economic uncertainty. Morgan concludes with a broader observation about the economic landscape, noting that historically, markets and communities find ways to adapt and mitigate problems during periods of significant inflation. He mentions the rise of cryptocurrencies, barter clubs, and local currencies as examples of such adaptations. This perspective suggests that as more countries and communities push back against the dominance of the US dollar, we could be approaching a critical juncture in the global economic system. Overall, David Morgan's analysis presents a nuanced view of the precious metals market. Emphasizing the importance of timing, diversification, and caution, he highlights the complexities of navigating a potential market surge while also considering the broader economic context. His insights underscore the need for vigilance and adaptability in an evolving financial landscape.